Let me ask you something that might reframe the way you've been watching this market. Every day, millions of people pull up a chart, stare at the silver price, and make a judgment. It went up, it went down, it didn't move. And based on that single number, that one blinking figure on a screen, they decide whether the silver story is alive or dead. Whether the thesis still holds, whether they should be worried or relieved. But here's the problem with that habit. The spot price is not the whole market. It isn't even the most important part of the market. And right now, the most important part of the market is happening somewhere the daily chart cannot show you. It's happening in the offices of procurement managers, in the contract desks of solar manufacturers, in the supply chain planning departments of defense contractors and semiconductor fabricators and electric vehicle battery plants. It's happening in quiet, unglamorous rooms where serious industrial buyers are signing multi-month and multi-year forward contracts for physical silver, not because prices are cheap, not because a chart crossed a moving average, but because they are no longer willing to bet that the metal will simply be there when they need it. That shift from reactive buying to anticipatory buying is one of the most significant signals in this market right now, and the spot price has completely missed it. Think about what it means when a procurement officer moves from buying silver when they need it to locking in contracts months before they need it. That is not a routine purchasing decision. That is a risk management decision. It means the people whose entire job is to ensure uninterrupted supply of critical materials have looked at the forward landscape and decided that waiting is no longer a safe strategy. They are paying a premium in commitment, in capital, in logistics to guarantee access to a metal they cannot afford to run out of. When industrial buyers get nervous, they don't sell. They secure, and right now, across multiple sectors simultaneously, that is exactly what is happening. I'll come back to what's driving that nervousness in a moment, because the reasons go much deeper than short-term price signals. But first, understand this. The spot market and the contract market are not the same conversation. One is traders talking to traders. The other is manufacturers talking to the physical world, and historically, only one of those conversations turns out to be right. Now let's talk about what these contracts are actually responding to, because this is where the story gets larger than silver itself. This isn't seasonal restocking. This isn't a quarterly inventory refresh. The forward contract activity being locked in right now is tied to industrial commitments that span years, not quarters, and the forces behind those commitments are structural. They are embedded in the direction the global economy is being pushed, whether markets price it accurately or not. Consider the green energy build-out. Governments across Europe, North America, and Asia have made long-term legislative commitments to solar capacity expansion. Those aren't policy suggestions, they are infrastructure. Programs with funding attached, timelines attached, and political accountability attached. Each solar panel requires silver, not optionally, physically. There is no substitute at scale. When you multiply the planned gigawatt expansion across those regions by the silver content per panel, you are not looking at a demand story. You are looking at a consumption mandate written into law. Then layer on top of that the military modernization cycle that has quietly accelerated across NATO and allied nations over the past 2 years. Defense procurement is not price sensitive in the way consumer markets are. When a government decides it needs a certain number of precision-guided systems, radar components, or communication arrays, it buys the silver required to build them regardless of what the spot price is doing that week. That demand doesn't negotiate with the market. It simply enters the supply chain and takes what it needs. And then there is the expansion of AI hardware infrastructure, the data centers, the processing units, the cooling systems, and advanced semiconductors that the technology industry is building at a pace that has surprised almost everyone. Silver sits inside that infrastructure in ways most people haven't thought about. The industrial footprint of the AI build-out is not just a technology story, it is a materials story, and the materials are finite. Here is the point that matters most. When a solar gigafactory signs a silver supply agreement, they are not buying for next quarter. They are buying for the next 3 years. That metal is spoken for before it is even mined. It disappears from the available forward supply before the spot market has any idea it was ever available. And when you add up enough of those commitments across enough sectors, what you are left with is a physical market that is becoming progressively more committed, while the spot price continues to trade as though none of it is happening. That gap between what the forward pipeline knows and what the screen shows is where the real risk and the real opportunity lives. So why doesn't the spot price respond? This is the question worth sitting with, because the answer tells you something important about how markets actually function versus how most people believe they function. The spot price of silver reflects one thing precisely: what traders are willing to pay for paper exposure to silver at this specific moment in time. It reflects sentiment. It reflects positioning. It reflects how much leverage is sitting in the futures market and how nervous those leveraged participants are on any given day. It reflects all of that clearly and efficiently. What it does not reflect, what it structurally cannot reflect in real time, is a multi-year forward contract signed last Tuesday between a battery manufacturer and a mining offtake agreement. That transaction doesn't flow through the futures exchange. It doesn't move the ticker. It doesn't register in the volume data that traders are watching. It is invisible to the mechanism that produces the number everyone is staring at, and this is not a new phenomenon. This is how commodity markets have always behaved at major inflection points. The contract market leads, the spot market follows, sometimes by weeks, sometimes by months, but the sequence is historically consistent. Industrial commitment accelerates, physical availability tightens, warehouse drawdowns begin, regional premiums widen, and then when the pressure builds past what paper positioning can absorb, the spot price snaps upward to close the gap. It does not gradually adjust, it snaps, because by the time the spot market finally acknowledges what the physical market has known for months, the repricing happens fast and it happens hard. There have been two clear episodes in recent decades where spot price lagged industrial demand in silver by a significant window, and in both cases, when the catch-up arrived, it compressed into a very short period of violent repricing. The people who were watching procurement data and forward contract behavior saw those moves coming. The people watching only the daily chart were shocked by them. The difference between those two groups was not intelligence. It was which data they had decided to pay attention to. So where does that leave us right now in this specific moment with this specific setup? The spot price not reacting is not a contradiction of the thesis. It is the thesis. The silence of the spot market in the face of accelerating industrial commitment is not evidence that nothing is happening. It is evidence that we are still in the early phase, the phase where the forward pipeline is filling quietly, where procurement managers are securing supply, where the physical market is tightening beneath a surface that still looks calm. The catch-up moment has a sequence. It doesn't arrive all at once. First, you see warehouse. Drawdowns accelerate, the numbers that track registered and eligible silver stocks begin declining at a pace that outstrips what normal arbitrage explains away. Then you see regional premiums widen, the spread between what silver costs in Shanghai versus London versus New York begins to behave in ways that tax structures and logistics costs alone cannot fully account for. And then the forward curve itself shifts, the relationship between near-term and longer-dated contracts begins to reflect. A market that is no longer comfortable with the idea that metal will always be available at a reasonable cost on a reasonable timeline. All three of those conditions are beginning to show early signs of alignment right now. Not all fully developed, not all at the point of no return, but directionally they are moving together. And when all three move together, the window inside which the spot price can remain unaware of what the physical market already knows becomes very short. This is what patience in a market like this actually looks like. Not watching the price every day and measuring your conviction against it, but understanding the sequence, knowing what leads, knowing what follows, knowing which signals matter and which ones are simply noise dressed up as information. The procurement officer signing a 3-year silver supply agreement is not watching the spot chart. They are making a judgment about the physical world over a long time horizon. That judgment is already reflected in a contract. The spot price will reflect it eventually. The only real question is whether you understand what you're looking at before that happens or after. This market has a habit of looking completely obvious in hindsight. The supply commitments are visible now if you know where to look. The industrial signals are present now if you know what they mean. The gap between the forward market and the spot price is measurable now before it closes. The spot price may not have noticed yet. But the physical world has, and in commodity markets, the physical world always wins. So let me ask you this, and I'd genuinely like to hear your thinking in the comments. When you evaluate silver right now, are you looking at the screen price, or are you watching the physical signals underneath it? And what would it take for you to shift how much weight you give to each? If this kind of analysis, calm, data-focused, grounded in how markets actually work, is the kind of content you want more of, consider subscribing. There are no shortcuts here. Just a serious attempt to understand what the numbers are actually saying, for people who are paying close enough attention to ask the right questions.